Welcome to our deep dive into two indispensable financial metrics, the debt-to-equity ratio and the interest coverage ratio. In today's dynamic business environment, understanding a company's financial health is paramount, not just for investors and lenders, but for business owners and strategic decision-makers alike. These ratios are far more than just numbers on a balance sheet. They are crucial indicators that unveil a company's financial leverage, its solvency, or its ability to meet long-term obligations, and its immediate capacity to service its debt obligations. Grasping these concepts allows for more informed investment choices, more prudent lending decisions, and robust strategic financial planning. They empower you to assess risk, identify opportunities, and ensure sustainable growth. Let's embark on this journey to demystify these powerful tools. Let's begin with the debt-to-equity ratio, often abbreviated as DE. This fundamental metric is designed to measure a company's financial leverage by comparing its total liabilities to its shareholder equity. In essence, it tells us how much of a company's operations are financed by debt versus how much is financed by owners' funds. A company with a high DE ratio is heavily reliant on debt financing, which typically implies higher financial risk. Conversely, a lower DE ratio suggests that a company is funding more of its assets through equity, indicating a more conservative financial structure and generally lower risk. This ratio provides vital insights into the company's capital structure, giving us a clear picture of its overall financial risk profile and its potential vulnerability to economic downturns or rising interest rates. Calculating the debt-to-equity ratio is straightforward, yet incredibly revealing. The formula is simply total debt divided by shareholder equity. Let's walk through an example. Imagine a company, Alpha Corp, has total liabilities, which encompass both short-term debts like accounts payable and long-term debts like bonds and loans, totaling $500 million. At the same time, its total shareholder equity, representing the capital invested by owners and retained earnings, stands at $250 million. To calculate Alpha Corp's DE ratio, we divide $500 million by $250 million, resulting in a ratio of 2.0. This means that for every dollar of equity, Alpha Corp has $2 of debt. You can easily find these crucial figures on a company's balance sheet, typically located within its annual reports or quarterly filings. Understanding where to extract these numbers is the first step to comprehensive financial analysis. Interpreting the debt-to-equity ratio isn't a one-size-fits-all endeavor. What constitutes a good ratio can vary significantly by industry, as different sectors inherently have different capital structures. For instance, a capital-intensive industry like utilities might have a higher DE ratio than a tech startup. Generally, a ratio below 1.0 is often considered healthy, indicating that a company is primarily equity financed. However, a moderate DE ratio, say between 1.0 and 2.0, might also be acceptable if the company has stable cash flows and strong earnings to support its debt. A consistently high DE ratio, particularly above 2.0, signals elevated financial risk. This could lead to higher interest rates on future borrowings, reduced creditworthiness, and a greater potential for financial distress, especially if economic conditions worsen. Therefore, benchmarking against industry averages and analyzing the company's historical trends are crucial for accurate interpretation. Now, let's shift our focus to the interest coverage ratio, or ICR. While the debt-to-equity ratio gives us a broad view of a company's leverage, the ICR offers a more immediate assessment of its ability to meet its interest obligations from its operational earnings. This ratio is profoundly important because it directly measures how easily a company can pay the interest on its outstanding debt. It acts as a critical solvency indicator, particularly for lenders, who scrutinize it to evaluate the risk of a company defaulting on its debt payments. A robust ICR suggests that a company is generating sufficient operating profits to comfortably cover its interest expenses, signaling financial stability and a lower risk profile. Conversely, a low ICR can be a red flag, indicating that a company might struggle to pay its debt interest, which could lead to financial distress or even bankruptcy. To calculate the interest coverage ratio, we use a simple yet powerful formula: earnings before interest and taxes, or EBIT, divided by interest expense. Let's take Beta Solutions as our example. Suppose Beta Solutions reported an EBIT of $100 million for the past fiscal year. This figure represents their operating profit before factoring in any interest payments or taxes, providing a clear picture of their core business profitability. During the same period, Beta Solutions incurred an interest expense of $20 million on its outstanding debt. To find the ICR, we divide $100 million by $20 million, which yields an ICR of 5.0. This means Beta Solutions' operating profits are 5 times greater than its interest obligations, demonstrating a strong capacity to meet its debt servicing requirements. These crucial figures, EBIT and interest expense, are readily available on a company's income statement, making this ratio easy to compute for any publicly traded company. When interpreting the interest coverage ratio, industry benchmarks and specific company circumstances are vital. Generally, an ICR above 1.0 is the absolute minimum, as it indicates a company can, at least on paper, cover its interest payments. However, a healthy ICR is typically considered to be above 1.5 and often ideally above 2.0 or even 3.0, signifying a comfortable margin of safety. For example, an ICR of 5.0, as seen with Beta Solutions, suggests robust financial health. If the ICR falls below 1.0, it's a critical warning sign. The company's operating income isn't even enough to cover its interest obligations, pointing to a high risk of default and potential bankruptcy. A consistently low or declining ICR severely impacts a company's creditworthiness, making it more challenging and expensive to borrow money and significantly diminishes its appeal to potential investors. It's a key indicator of a company's financial stability under current operational conditions. While both the debt-to-equity and interest coverage ratios are powerful on their own, their true strength lies in their combined analysis. They complement each other, offering a holistic and nuanced view of a company's financial health. The DE ratio reveals the fundamental structure of a company's financing, how much debt it's carrying overall. The ICR, on the other hand, tells us about its operational capability to manage that debt burden on an ongoing basis. Consider a scenario where a company has a high DE ratio, indicating significant leverage, but also a very high ICR. This suggests that despite its reliance on debt, the company is generating robust operating profits to comfortably cover its interest payments, making the higher leverage potentially manageable. Conversely, a low DE ratio combined with a low ICR might still be a concern, as even a small amount of debt could become problematic if operating profits are insufficient. Analyzing these two metrics together provides a comprehensive risk assessment, revealing not just the amount of debt, but also the ability to service it, giving investors and creditors a much clearer picture of financial stability. In conclusion, the debt-to-equity ratio and the interest coverage ratio are not merely abstract financial concepts. They are tangible, actionable insights into a company's financial health and solvency. By consistently monitoring the DE ratio, you gain clarity on a company's reliance on debt and its associated leverage risk. Simultaneously, the ICR provides an indispensable gauge of its operational profitability's ability to cover interest payments, a direct measure of its short-term solvency and default risk. For ambitious professionals, entrepreneurs, and active investors, integrating these metrics into your financial analysis toolkit is crucial. They empower you to make more informed investment decisions, mitigate financial risks, and guide strategic growth. Remember, financial landscapes are ever evolving, so continuous monitoring and benchmarking against industry peers and historical data are absolutely essential to sustain long-term financial stability and achieve your strategic objectives. Embrace these metrics, and you'll be better equipped to navigate the complexities of the financial world.